Hello everyone and welcome to your Glassnode video report for week 39, 2022. What we are looking at today is what we're calling the Great Bitcoin Bear Market Detox, and this is essentially the process of all speculative premium being flushed from the space. And we're going to look at this from two different angles. The first one is the on-chain activity space, which is really how utilized is the network. And we're going to look at this through the lens of what we're calling momentum. So we're really looking at what does the near-term behavior look like relative to a longer-term average. And this is a really powerful concept you can apply throughout many layers of Bitcoin analysis. The next layer we're going to look at is the short-term holders in particular. We're going to look at their supply concentrations, look at how that overall is going to affect the market. And what does it mean as we get closer to this point where there is a somewhat of an equilibrium down here in the $18,000 to $20,000 realm? So as I mentioned, we have reached some degree of an equilibrium. We've essentially purged all speculative capital. We've talked about this for a number of weeks now. We're reaching that point where there's only hodlers left. And these bear markets, they're a process, right? When we do look back and we see what the final bottom looked like, a lot of these things will make a lot of sense in the rearview mirror, but actually judging them at the near face is much, much harder. So what we're looking for is, when do we have that complete detox? When do we kind of reach the baseline? When do things calm down and the speculative premium has been flushed from the space? Now, you can interpret that from a few different angles. One is, if the market decides to trade lower, then you would argue that we're now approaching extreme undervaluation. You can also look at it and say, well, if we're establishing some kind of an equilibrium, then that kind of provides some evidence that there could be a floor forming. Again, with all of the world happening around us, both of these options could be true. So we really have to just assess these things as we go. So, and the last thing we're going to close out with is looking at short-term holders and young coin supply. This is a really, really interesting topic, one that I use quite a bit, trying to assess what does that balance between long and short-term holder supply mean, and then also projecting that to say that is a long-term view versus the more near-term view, which we're going to look at with the on-chain activity. So as always, please do give us a rate, a share, and a subscribe. And I do hope you learned something new, particularly around these on-chain activity momentum oscillators. These are a really, really powerful tool, and you can use them for a great many on-chain analysis techniques to essentially smooth out the noise and obtain more of the signal. So let's get started. So here we are in the week 39 dashboard, and we can see that we are essentially trading up and down within this consolidation range. We've essentially been here since June, since we sold down here in the middle of the year. We've seen a little bit of a bounce off the bottom here. However, this well and truly remains within the consolidation space. We haven't yet seen the market make a decision whether it wants to move higher or lower. And that is why we're really focusing on trying to identify, what does equilibrium look like in terms of the fundamentals. So the first chart we're going to start with is the number of new entities. Now, we define at Glassnode an entity because we know, and you've probably experienced this if you've used Bitcoin for any period of time, you can own more than one address. Now, an exchange will have many millions of addresses, but for every single deposit, every customer. And what we do is we distill that down using clustering algorithms to say all of these addresses, to our best estimate, are Binance. All of these are a certain mining pool, and all of these are mysterious investor number X. So what we do is we use this clustering algorithm to try and measure the total number of new users on chain. So it's trying to break it down. Instead of looking at addresses, we accept that some of those are going to be owned by multiple people, and we're going to then break down and say how many of those addresses are consolidated or clustered to a single owner. Now, what we're really looking for here is a break up or down to really display that there's more or less users coming into the system. The bull markets are pretty clear. We can see these large upticks in new entities. Bear markets, a large collapse normally starts them, and then we enter this bear market channel. Now, as you can see, we are currently hovering around the bottom of that bear market channel. And in fact, you could even argue that we are pushing down to the lows of it. We've essentially returned to March 2020 at the bottom. We are actually now below that level. So it is a little bit dire. We've been talking about this for a number of weeks, but essentially there are very few reinforcements coming in. We really are talking about a hodlers market at this point in time. So within that frame of reference, there's a whole lot of people there who believe in Bitcoin, but that's essentially all that's left. There's obviously the traders and the algorithms and all that operating around them, but overall, and we'll see this through many, many metrics, it's the hodlers that are left. And there's very few other investors, and that's both good and bad, because you can have those hodlers, they're the highest conviction holders of BTC, but they're also the only ones here. So it's this interesting dichotomy, and we'll explore that a bit further. So this is the first one that I want to explore. I mentioned momentum and these new indicator types. So that same metric, new entities, what we're looking at here is the monthly moving average, the 30-day moving average in red versus the 1 year in blue. So what we're really looking for here is essentially a fast, slow indicator. So when you have the moving average, the fast monthly moving average breaking higher than the yearly, that's generally coincident with bull markets. We're seeing more activity in the near term relative to that longer term average. Now, note here that this started to decay as we formed the topping pattern here in February, March, April, and in fact, we had a negative crossover at the top. So this is before we had our May sell-off. And you can see that this also triggered quite early on in the 2017, just after the blow off top. We're up here at about, this was 14,000 when this thing actually crossed over. So relatively early in the trend, because we see this massive collapse in users in the near term. Let's just jump back to this chart here. You can see the blow off top clear as day. We get this massive decline in new entities coming in, and that's essentially happening before the peak gets put in. So what we can see is that we have been well and truly below the yearly with a very, very short period above for most of this bear market. And as you can see, we still remain well and truly below that. Now, back in 2018, we actually broke up and above as we pushed through, as we essentially sold down to that final level in November 2018. We saw that the market started to reverse. People saw those prices and saw an opportunity. We started to see on-chain activity really pick up during the bottom here in 2018. We have not yet reached that. And on the monthly basis, we're actually back down where we were here in July. Now, remember, there's kind of two interpretations here. It's always the darkest before the dawn, right? Things bottom at the worst point. That's kind of the definition of a bottom. But simultaneously, we have not yet bottomed yet. And this is why I'm trying to describe that we need to go through the process of looking at where is the equilibrium across multiple metrics, because we don't know when a bottom gets put in until it's actually happened and we're some distance away from it, both in time and price. So we're trying to assess this at the front phase, and there is going to be variability and uncertainty in that assessment. But we are essentially at the same level that we saw back here in July 2021, right before we pushed to new all-time highs. What we would really want to see is this start to pick up. We don't really want to see this keep trending lower, although within the current macro environment, that is most certainly a possibility. So now bringing it to another concept, we're looking at retail participation. So quite often, we've released a number of articles in our Market Pulse series looking at this. We can generally use median transfer volumes as to represent the average punter, right? We're looking at retail level investors, and that's because we have a positive skewness in Bitcoin transaction data. What does that mean? There are far more people sending $100 than 100,000. There are a lot more transactions on a counting basis that are smaller versus far fewer that are bigger. So when we look at medium transfer volumes, we are essentially identifying what's going on with the retail participants. Now, at blow-off tops at the market highs, you can see that we have the maximum number of retail participants. The median starts to climb. Everyone's making money. People have turned their $100 into $1,000, and everyone's very excited. What we then see is a collapse in that retail participation. And as we start to bottom out, we form this long-term baseline. We had the same thing. We peaked up and around this April to May high, and we've essentially been descending, and we look like we're starting to form a bit of a bottom. Now, again, this bottom can take some time. Back here in 2018, it was all of 2019 and into the start of 2020. It was really that March 2020 event that kicked the thing off. But as you can see, when we start to flatten out, it generally signifies that the worst phase of the bear is over, and we're starting to head into that reaccumulation. We're starting to get into that point where there is value back in the market and the speculative premium has been flushed out. Now, we haven't quite yet bottomed out, but it certainly looks like we are getting there, and we will have to watch and see how this plays out over coming weeks. But it's that first indicator that we may be getting closer and closer to that equilibrium point. And in a very, very similar pattern we have here, this is our median transfer volume. Again, we're doing our monthly divided by our yearly. This is that momentum factor we were looking at. And we have a similar behavior. We start to bottom out. The yearly starts to decline, showing that that bear market has really flushed out all that speculation. And then we start to return back into a more healthy recovery. So we are currently in this position where we are still diverging, but they are starting to flatten out, starting to look more like this back end of the 2018 period. And it's showing that we have reached a fairly significant degree of detox. We've flushed out most of the speculative capital, and we are essentially entering that reaccumulation phase. We still have to see whether the market can actually hold these levels, or if we're kind of sitting up here at 6,000 and there's another leg lower before we finally plateau. We will see. And the last one we're going to look at on this front is the miner revenue coming from fees. Now, fees is a fantastic model for looking at in terms of block space congestion. When you start to see fees picking up, it means that more and more people are trying to transact. And you'll see things like active addresses, you'll see transaction counts. Many of these on-chain activity metrics, they're very interlinked, and they will typically move and display and show similar characteristics. Now, where we are at the moment, we can see that we are in a period where we are still in bear market territory. So we have not yet seen that recovery as we see here in 2018. When we start to get fees ticking back higher on a statistical basis, it's generally a sign that we have some upside momentum. Now, we do not have any form of uptick just yet. So again, across all of these metrics, whether it's retail participation, whether it's new entities coming into the system or transaction fees, we're forming that baseline, but we haven't yet seen the recovery phase. So again, let's stay really cautious here because at the moment we haven't seen evidence yet that we have bottomed out. We're still in that process of forming that low, even if the speculative capital has detoxed. So now we're going to transition to looking at lifespan. So lifespan is actually a really powerful and arguably unique element to when we're looking at on-chain analysis. You really can't do this with any kind of accuracy in the traditional finance world. It really is a blockchain specific element. And what we're looking at here is the age of coins, the ones that are spent and the ones that are still held. So when we're at this point of complete detox, we're essentially left with just the hodlers. We established that early on. And what do we want to see, or what really describes that behavior? Well, when the long-term holders, the people who have held their coins for a long period of time, over 6 months in this instance, when they stop spending, it doesn't necessarily mean that it's bull time, but what it does mean is that they've reached a level where they're like, I will not sell at these prices. And as you can see, this peak here aligns roughly with around the January high. We saw a lot of on-chain metrics peak in January 2021, and that was essentially, it was kind of the final impulse before we bottomed out and we started this bear market process. And as you can see, over the course of that last year and a half, we have seen a net decay, a decline in the dominance of these older coin spending. There's been a few spikes along the way as we had capitulation events, all-time highs, lunar collapse, the sell-off below 20,000, but you can see this macro decay, and actually old coins are representing an extremely small proportion of spending behavior right now. And that's really what you want to see, because that means that old hands, people have held their coins through all the volatility and all the chaos that the last 6 to 12 months has held for us, they're sitting tight. So we're starting to see that change in investor behavior. We've almost reached that plateau, and that detox has more or less happened where people who were going to spend, who bought the top, they've more or less done that at this point in time. Now, if we were to get a flush out lower, we would have to see how this metric behaves. If we get a large uptick, that would start to signal, right, these guys have actually now completely purged. The final sellers are out of this space, and we may well have that final capitulation wick. The other side is if they do absolutely nothing and this metric stays very, very low, it would indicate that they just don't care. They do not care that prices are going lower, and they are willing to go down with the Bitcoin ship wherever it may take them. So that was the spending behavior. They're coins that are actually being spent on chain. What we're looking at here is the unspent coins. We're looking at the coin supply in the HODL wave format, so looking at it by age bands. We're looking at this only on the USD denominated basis. So there's two types of HODL waves. The standard one is on a BTC basis. And the one we're looking at here, the realized cap HODL waves, is on a USD basis. So how much of the USD wealth is held in each coin age? So what we're actually seeing right here is the coins up to 3 months old. And the really important insight here is that this is pretty much at all-time lows. So when you have the young coin supply at all-time lows, that means that you have the old coin supply at all-time highs. So you can see that we very, very rarely get down to such low levels. Here we were in 2015, arguably right before we started the next move higher. Here we are in 2018, where we're actually higher than we are at the moment, but pretty much at the lows. March 2020 didn't even get down this low. So we are at an extreme level of HODL. We are seeing the maximum number of coins that we have ever seen on a USD denominated basis HODLed. It's quite remarkable to see. And when you combine the fact that these older hands are just simply not spending, their spending is pretty much back down to 2015 levels. It really hasn't been that way since 2015 or early 2016. And we've got an all-time high in wealth held in those older coins. It is quite a remarkable thing to see. We literally do not see this very often. Now, here we are looking at our 90-day coin days destroyed. So coin days destroyed is kind of a time and volume weighted metric. How much time or coin age has been spent from the system. Now, what we do is we sum it up over 90 days, and that's what this oscillator will show us. Very high values means that lots of those old coins are coming back to life. You can see they typically happen in bull markets. This is the old money taking profits. They're using their coins from 1-2 years they've held for a whole lot of time. They're selling and taking those large 10, 5, 20x, whatever the gain is, they are spending into market strength. We can see here in 2020, we had that same blip. And normally during bear markets, we form this decaying floor. This is essentially a very low or a baseline level of coin day destruction. Well, here we are breaking down to what is effectively an all-time low. I really would ignore everything up to about 2011. This is too early. And also we're going to have coin days. There's more time in the system and we do adjust for these things. But really what we care about is this is effectively, in modern history, none of us were around in 2011. If you were, well done. But most of us were not around at that point in time. So this is effectively an all-time low. So what this means is that the amount of coin age that's being spent from the system is pretty much non-existent. We're seeing so few old coins on the move. And it's not as if people aren't aware that it's a pretty nasty bear market. People are quite aware that things are a bit hairy out there. This really looks like hodlers who just don't care. They are putting up the sails and they are going wherever the Bitcoin ship is willing to take them. So the last thing that I want to close out on is our long and our short-term holder supply. And I want to capture this from two perspectives. You've probably seen this through this video in particular. There's a bit of a dichotomy going on. Long-term holders, as you can see here in blue, look at all these guys. They've got coins up here at 60,000, almost 70,000. It's not as if these guys don't know that price is down at 18. So what we're seeing is that these folks are pretty unwilling to spend. We see it across so many metrics above. So we have a hodler class who just simply doesn't seem to care. We'll see if price trading lower, if that does happen, whether that changes that dynamic. But right now, they appear to not care, which is quite remarkable, but it's also a very Bitcoin-like thing. The other observation is our short-term holders, these red coins. So what we're looking at here is coins clustered around the 20,000 level. And this signifies two things. One, someone had to spend them and capitulate out during these levels. Someone else had to come in and buy them because there's two sides that make a market. So what we're seeing here is a huge influx of demand. You can see that this cluster is very, very large relative to the rest of Bitcoin's history. It stands out. Now, there's an air gap below us. There's very, very few coins that were transacted between about 12,000 and 18,000. So there is somewhat of an air gap there. Doesn't necessarily mean it has to be filled in, but there is a risk that there's just not that much history in terms of supply transacting in that realm. And often you'll find that these things typically align with technical analysis. You'll see that the previous peak in 2019 was about 14,000. So it does tend to align. There is also an air gap above us, up to about 28,000. So depending on which way price goes, there's essentially one of those very same volume profile style air gaps, both to the upside and the downside. And we'll have to see how that plays out. Now, the risk here, note that this black curve, this is about 18,000 where we were sitting before when this report was written. And you can see that it's at the bottom end of all of these short-term holder coins. So they are currently in loss. So this is the total supply and profit held by those short-term holders. And as you can see, we are pretty low. There's basically no coins held by short-term holders in profit. And these guys are the most likely to spend in the face of volatility. So we're in this position where if we get the levy break and price breaks down below, it may well trigger them all to go, that's it, get me out of this thing. I haven't got the best entry price, I must sell. Simultaneously, it could be that these folks are actually long-term holders that just haven't held their coins long enough. So what we typically see in these patterns, we see this large expansion of short-term holders in profit during the bull. We then collapse down, and note how we then consolidate for a period of time as we form the bottom. Bull market, we have an expansion in coins in profit. The top comes in, we have a massive collapse in short-term holder supply, and then we consolidate down until we expand yet again. So here we are, we've had our blow off top in 2021. We've then collapsed down, we've consolidated, and we're getting close to that equilibrium point. The market's getting ready to make a decision, and we will see how this plays out. So we do have a risk, if we do break down below, that those short-term holders can actually flush out once more. Simultaneously, we also have an air gap to the upside. So it's one of these very interesting dichotomies where it kind of could go either way. And the last metric I want to talk about is on the momentum side. So we're looking at, as all of these red coins, as they cluster around the price, short-term holders' cost basis, the price at which they acquired their coins, is now in sync. We're essentially at the current market price. So they're more or less in sync. And this typically happens. What this momentum shows is high positive momentum means that there is a higher probability of a blow-off top. Large downside momentum indicates that we're more than likely at some kind of large negative inflection point, almost like a capitulation bottom. Note that as we come into the late stage of the 2018 bear, this thing goes quiet, really, really quiet. That's showing that the short-term holder cost basis has now entered in sync with market price. Rather than them getting flushed out and then buying the dips and then getting flushed out at the top and this volatility of the early bear, they enter this quiet period. This shows that the cost basis of short-term holders and the price are in sync. Now you can see that we've had that same wild swings to the upside, wild to the downside, back to the upside in November, and we have really, really compressed. So we're starting to get to that point of equilibrium. So it's a very, very interesting dynamic. This market is extremely challenging to read. So if you're like me and you're trying to assess all this information, you're not alone. It's really challenging out there. But what we are seeing is we're approaching that state where really Bitcoin is at a degree of equilibrium. Short-term holders have stepped in down here at 20,000. They are a risk if we break lower. We have to keep that in mind. All these things are possible. But we're also reaching a point where there's a very, very large volume of hodlers in the market. And a great deal of those short-term holders are likely to also be long-term holders that just haven't reached that point yet. So we can see in the behavior pattern that overall, it actually looks fairly good in the longer term, in the medium term even. It's that short term that remains pretty chaotic, and there's still some risks sitting out there, but it looks like a huge proportion of Bitcoin holders, they're going to go up or down with the ship, whichever way it decides to take them. So thanks as always for tuning in for that, folks. Hopefully you found that a useful overview. It is a very dynamic market, very, very challenging to read. I would pay attention to the realized cap HODL waves. These are such a powerful tool. You can do so much with them by turning off and on the legend. I will typically turn things on up or down to look at coins up to 3 months old, up to 6 months old, or the other way around. You look at coins that are older than 3 months or older than 6 months. That's a really good way to just get a view of what the old and the young coin supply is doing. And remember, an all-time low in young supply means an all-time high in old supply. So this is a really nice way to just track that hodler behavior over the long term. Thanks for tuning in, and I'll see you in the next one. Cheers.